again frame it. Thanks a million. So for FJI, this is part of our work in GCE, Global Citizenship Education, or also known as development education. So a really powerful tool to look at ways of trying to make sense of the world that we live in, an increasingly unequal world, and injustices that go along with that inequality. So it helps us to understand root causes of injustice locally and globally so that we can find ways to build a more just and sustainable future for all of us. The work that we're looking at today draws on Tom's great work with Oxfam and with the Nevin Institute. So Tom is the co-director of the Nevin Institute and Nevin Economic Research Institute, is that to put it fully. That is a think tank affiliated with the trade union movement in Ireland and is interested in developing an economic model that is based on fairness and sustainability for, an economic model that would serve all of us, as well as economic literacy, the belief that actually in order to contribute to these conversations, we need to have citizens that can understand the issues, understand what's up for debate and frame our demands around our collective needs. So for Financial Justice Ireland, we're by no means on our own seeing tax as a justice issue. Oxfam, Action Aid, Christian Aid, Trócaire, there's so many organisations that we might associate with dealing with the symptoms of poverty locally and globally have also been working really hard to challenge some of those root causes. So recognising tax abuse as one of the mechanisms by which the inequalities that we're seeing growing alarmingly at a global and a local level. So recognizing tax as a problem, but also, I suppose, seeing it as something positive, as an instrument that could be used to address the accumulation of extreme wealth and the kind of anti-democratic control that goes with all that political influence that extreme wealth carries with it, and seeing tax as a true tool for social justice that would help to fund the things that we all need and deserve, as well as the urgent requirements that we think about how do we finance a just transition to a more sustainable way of living within the boundaries of our common home. So this is the framing for a lot of the work that FJI does, and it's absolutely why we're here today. And so really, really grateful to you, Tom, for coming today to sort of help address this question. As we were setting up, we were just chatting and explaining that wealth tax in particular is just like such a hot topic. It's coming up in every school I visit, with teachers I'm talking to. And I was chatting to my own children before we started this, kind of, early 20s, and they were saying, what are you doing today? And they're like, oh yeah, everybody's talking about wealth taxes. So we're very lucky, Tom, to have you talk us through this. And I know your presentation goes to different levels of depth, because people will be using them for different, the information that we look at here for different purposes. So I think you're going to kick us off with just even thinking about, like, if we're talking about wealth taxes, what is wealth? How should we understand the concept of wealth to help us understand wealth taxes? We're also delighted that you're happy to take questions as we go along. So if people want something kind of clarified in the moment, feel free to stick up your hand or come in. One of us will notice that, or unmute if you'd like to just come in and have something clarified that would help that learning process as we go along. But otherwise, if you have questions that you think you'd like to put at the end, feel free to start putting them in the chat at any point, and we'll keep an eye on those as well, and we'll have time at the end for that. We'll also share some resources at the end, reports from Oxfam and elsewhere, and resources that FJI has on looking at tax in a secondary school classroom context with our resource, Just Tax. So with no further ado, Tom, I'm just so grateful that you're here. I'm really grateful to everyone that's coming today and who will watch later on the recording to take part in this conversation. Just while you're unmuting and setting up there, Tom, I just also wanted to say, Tom has been, like, apart from in your role in the
Yeah,
Nevin Institute, a real friend to FJI over the years as well, and helping us to form an understanding of, tax policies and debt policies as they're unfolding. And it's lovely to have you back today. Thank you.
delighted to be back, Vicky. It's very kind to be invited, and I'm always happy to talk about wealth taxes and tax justice generally. So, I know the debate in Ireland as well at the moment is uh, becoming quite fractured in terms of the social contract. We've seen that in recent years. I know certainly within the trade union movement, there is a desire to move the framing back towards being one around the common good and trying to understand, well, what would an intervention to the fuel crisis or to a pandemic or whatever it might be, how would one do that in a way that benefits society as a whole? And with another one of my caps, I was a member of the Irish government's Commission on Taxation and Welfare, and one of our jobs was basically to look through the entire tax system, the entire welfare system, and see if it was sustainable for the decades ahead, and if not, what to do about it. And one of the things we really honed in on was the need for higher taxes in the long run with an aging population. It's going to become very expensive, and one of the levers available to us is capital taxes. So a wealth tax is one of those capital taxes that we can look at. At the same time, we have a world of increasingly grotesque and glaring inequalities of wealth, and a greater movement or sentiment toward the need to tax wealth in the future. Uh, and another driver in the years to come, which will probably make this even more salient, is the rise of artificial intelligence and the possibility that increasingly the gains from economic growth will go to a smaller and smaller subsection of capital or wealth holders in society. So, with that context, Oxfam asked us, along with Sordy McGahey, who's an independent researcher, formerly of Christian Aid, and elsewhere, Kieran Nugent was the third researcher to put together an outline of what a wealth tax might actually look like if Ireland were to do it. And of course, one of the ideas there is that that could then become a template for what other countries might decide to do. So I suppose if you're to look at a wealth tax, the first obvious question is, what's wealth? And really, sorry, just trying to move on the slides there. Seems to be, there we go. So, you know, what is wealth? The important thing to know is it's not the same as income. It's a stock, whereas income is a flow. So your income that you get for working in a job or receiving a pension or being a landlord or whatever it might be, that is a flow of resources that come into you on a hourly, weekly, monthly, annual basis. But your assets are the stock. They are the things that generate the flow. So, um, for example, not all assets will generate an income. So if you're living in a big stately home, that you may not be generating an income from that, but you're still gaining value from it. You're consuming the value of living in that house and so forth. And if you wanted to live in somebody else's stately home, you would have to rent it out. So simply having the asset yourself means that you're getting value that you wouldn't otherwise have to expend. So there's effectively a rental income associated with it. There's also other things too. So wealth and income are very, very different. Wealth tends to be much more concentrated than income over the whole of the population. And I suppose when we're talking about a wealth tax, it's important that we note that it's about your gross assets. So add up all the value of the vehicles, pensions, land, all the things that you own, minus your liabilities. So if you have 400,000 in assets, but you owe 4 million, you're actually not wealthy. You're massively in trouble, in fact. So a wealth tax is really about net wealth. Um, and wealth itself is broken up into different types of assets. So there's real assets, such as a house, and financial assets, such as stocks or bearer bonds. Some are transferable, such as cash or whatever it might be. Some are non-transferable, such as life assurance. Some are mobile, such as vehicles or cash, and some are immobile, again, like land or a house. Some are liquid, some are not liquid, and so forth. So there's various types: land, houses, business equity, agricultural assets, vehicles, cash, life assurance, pensions, securities, things like stocks and bonds, but also your human capital. Your skills and your knowledge provide you with the ability to generate income. It is an asset that you have. And then things like personal property, such as jewelry as well. Crucially, for most people, at least for most people in the middle of the wealth distribution, the household, the home, makes up over half of their wealth. And it makes up over half of all wealth in the distribution, full stop. Now, it's different for people at the top and it's different for people at the bottom. People often at the bottom of the wealth distribution would be renters. So their main assets may be things such as cash and vehicles and personal items and things like that. And at the top of the wealth distribution, it's quite different again. It's not about your family home. It's about business assets, it's about financial assets, and it's about land assets, agricultural assets, those type of things. So the type of wealth that people have at the top of the distribution is often very, very different to what your more average household would have. So when we talk about a wealth tax, usually we're talking about tackling excess wealth, the type of wealth that allows you to have to almost be exempt from the basic worries or cost of living crisis or ordinary financial concerns that most households would have. So we're not necessarily here talking about a tax that would fall on people whose main asset is their home. It's more likely to be people whose main assets are financial assets, business assets, and those type of things. And one of the big debates that you have to have when you talk about wealth taxes is, are we taxing wealth in its entirety, or are we taxing excess wealth? What is the problem here? Is it the fact that certain groups have excess power in society, or is it that we want to tax wealth as a thing in itself? Or is it enough to tax the income on regular wealth? So when you're looking at designing a tax, you have to think about your rationale. Well, why do you want to do this? And I suppose the most obvious reason is because you want to raise tax for government spending. So you want to pay for education, you want to pay for pensions, you want to pay for healthcare. So your first question is, can this generate money for the exchequer? So could it generate billions, millions, whatever it might be? If the answer to that is yes, potentially you can look at what are the other rationales for doing it. And number two and number three kind of fall together, and they're really the equality angles or the justice angles. So horizontal equity, it's a wonkish term, but horizontal, essentially we're saying that people that are in the same situation should be treated the same way by tax authorities. So it shouldn't matter if your quality of life or your well-being is generated from your income or from your wealth. It should be the combination of the two that matters here. One thing that arises from that is that things like the source of your income, your age, what type of activity you're involved in shouldn't actually matter here. It should just be that everyone is treated the same. So it shouldn't be about just your income, it should be about your combined wealth and income. The other equity argument is what we call vertical equity. And this is that while we treat everyone at the same level the same, people with more resources should have a higher tax obligation on the rest of society because they benefit more from being in a society. And if greater access and power within that society, they benefit more, but also they have the largest shoulders, they can bear more. So it's simply more just to take more off people at the top than it is to take equal amounts from everybody when everyone doesn't have the same capacity to bear all of this. Again, that implies a justification for a wealth tax on top of income tax. The fourth argument then is that we want to minimize economic distortions. So you want to design a taxation system that doesn't wreck the economy. So if wealth taxes would wreck the economy, then that would be potentially a strong argument not to do it for obvious reasons. Uh, so where does it stand versus income taxes or taxes on consumption, things like VAT or excise taxes or whatever it might be? How does it compare to property tax? How does it compare to PRSI and all of those things? So when we're deciding how to design a tax system, we have to look at those questions as well. And we'll come back to that. And then there's two other issues which you need to think about in terms of a wealth tax as risks, and maybe we'll talk about them a little bit more in Q&A, is that you want to minimize the risk of capital flight. It's all very well bringing in a wealth tax, but if the wealth can just simply escape, well, you're not going to get any money from it and you're not going to achieve your goals. And then finally, you want to have a simplified tax system which minimizes administration and compliance costs. That's just wastage and tends to benefit more powerful, richer households that can hire very, very clever accountants and lawyers to allow them to avoid things. So, what are wealth taxes? Well, they're a type of asset tax. They're a tax on a stock, and they fall within a family of taxes called property taxes. That includes your local property tax. It might include land taxes. It could include capital levies, which we've seen in some countries brought in after wars, where there's a once-off tax on richer households to pay for reconstruction. There's three main type of wealth tax. So there's tax on wealth transfers. So it's like taxing inheritances and gifts. We do that in Ireland, called capital acquisitions tax. Taxes on capital appreciation, we call it capital gains tax. So it's not really a wealth tax per se, it's a tax on the increase of the value of an asset. And then taxes on net wealth holdings, such as a net wealth tax. And we don't have one of them in Ireland. Countries in Europe that do have wealth taxes are Spain, Norway, and Switzerland. Some other countries, such as France, have a worldwide real estate tax. Italy has a kind of a financial tax and a tax on real estate held abroad. There isn't an EU level wealth tax, at least as of yet. And one of the interesting phenomena is that far fewer countries have wealth taxes now than have done so in the past. But as I will explain later, the reason why wealth taxes have failed is because they've been really, really badly designed. So, uh, you know, that's not an argument against wealth taxes per se. It's an argument in favor of doing it properly. So what I'm going to argue in favor of is not necessarily any wealth tax, whatever one you're having yourself. It's that yes, you can have a wealth tax and should have a wealth tax, but you should design it properly as well. And if you don't do that, then it's going to fail, and we'll be back to square one. Again, I've made the point: a net wealth tax is just a tax on your gross assets minus your liabilities, all the debts that you hold. And there'll be all sorts of caveats in terms of design. So what type of wealth assets qualify? I would argue that they should all qualify. Should there be a threshold? I.e., are you only taxing over 100,000 or a million or 40 million or whatever it might be, and taxing on the bit above that? And there's various ways that you can calculate it. These are going to be in the slides. I'm going to push through them now for ease of conversation. But just to note that the wealth taxes that have existed in other countries have generally only brought in a very small proportion of government revenue relative to the size of the economy as a whole. And that's because wealth taxes have often been riddled with all sorts of exemptions and reliefs. They tend to be high thresholds, and they tend to be set at very, very low rates. And there are reasons for that. Rates have generally been between 0.2 and 2.5% on net wealth. And you ask, well, why are they so low compared to income tax? Well, the reason is that the return on a capital asset might be somewhere between 5, 6, 7%. So let's say it's 5%. That means a 1% wealth tax, 1 divided by 5, is actually 20%. A 2% wealth tax would be 40%. A 10% wealth tax would be 200%, which isn't sustainable. So that's why rates tend to be much lower than it would be for VAT or income tax or whatever it might be. And a lot of other factors go into determining the yield. What's your base? What's the distribution of wealth in the population? Are there thresholds? Are there exemptions, reliefs, and so on? And they can have very significant influences. Having estimated this in the past, back in 2013, we had a lot less wealth in 2013, but I estimated we could yield at least 300 million. The ESRI looked at this again in 2016. They came up with a figure of potentially $250 million or so, perhaps a little bit more. But now our net wealth has increased enormously in the 12 or 13 years since. Remember, that was coming out of a great financial crisis. We now have over 1 trillion in net wealth held by Irish households. 1 trillion. And that means that you would have a much greater yield than those previous estimates given a particular rate or threshold. Looking at wealth inequality in Ireland today, you get different statistics depending on whether or not you use one of two prominent data sets that exist in terms of wealth distribution in Ireland and elsewhere. And I would note that depending on the data set you use, you will get a very different outcome in terms of wealth distribution. So in terms of wealth inequality, the World Inequality Database suggests that up to 2/3 of wealth is held by the 10%, by the top 10%. But European Central Bank and CSO data suggest that about half of all wealth is held by the 10%. Regardless of whether it's 2/3 or a half, though, I think you'll agree that the top 10% of households still control a very significant and disproportionate share of all wealth in the country. In terms of the top 5%, then, depending on your estimates, you get either half of all wealth, or about 1/3 of all wealth held by the top 5%. And then we've got data too on the top 1% of households. So the World Inequality Database, which is based out of, I should say, Paris and Berkeley, they suggest that Ireland, which is this little green line here, about 22% of all wealth is held by the top 1% of households, which is about 18,000 households in the Irish context. But the ECB CSO data indicates that the top 1% control 13% of all wealth assets. So we've got a range of somewhere between 13% and 22%. Somewhere in the middle of that would be about 1/6 of all wealth controlled by just the top 1% of households. And then also to look at the distribution. So the type of wealth held by the top 1% is very different from the rest of society. If you look here, you can see that for the middle 2 deciles of wealth of the Irish population, 5 and 6 deciles, just 10 of them, about 80% of all their wealth is held by your home, is held in the form of a home. But if you go to the top 10% of the population, less than just under 1/4 of their wealth is held in the form of a family home. So most of their wealth is not the home. And you can see the breakdown here in terms of this bar chart here at the bottom, in terms of the households that have received inheritances. So you can see that households in the top deciles are much more likely to have received a substantial gift or inheritance than people at the bottom. And we know from other research that potentially 2/3 of all wealth is inherited wealth. So there is a very significant intergenerational inequality that's going on here. It's not necessarily that people have earned their wealth. It's that it's been simply transferred down generation to generation. And we can see this reflected in the disproportionate power that people have. So even today, 1,000 years after the Norman invasion of England, the major landholders in England are still basically the same people and the same families. So if you look at the top of the Conservative Party in the early 2000s, you've got names like Haig and Cameron. These were people who came over as knights, as ancestors under William the Conqueror in 1066. And 1,000 years later, the system is so rigged and the lack of movement in and out of the top 10% is such that they still hold that wealth 40 generations later. And we can see data from places like Florence and so forth, that the same households that were dominant during the Renaissance are still the same households that are the powerful families in Florence to this day, which you can see in terms of even the same surnames. In terms of the type of wealth held by people at the top, I mentioned for the middle household, 4/5, 80% is basically your home. And if you look at all the other categories, then of the remaining 20%, about half of that is cash mainly, and then a little bit is other real estate, but very little. They're all small numbers, 3%, 2%, that type of thing. But for the people at the top 10%, and this is even more skewed for the top 1%, you can see that actually self-employed business is where their main assets are. So if you give business supports, you're basically giving money to the top of society. You can see that household main residence is still pretty big, but it's only a quarter. And look at land. For the middle household in Ireland, 0.7% of their net wealth on average is land, but it's 16.1% for the top 10%. So a land tax is another type of wealth tax, which basically hits people at the top of the distribution. And all of these numbers become more skewed again as you get to the top one. So we looked at how much money you might bring in if you had a wealth tax. So looking at 1% wealth taxes, you first of all have to go through some pretty complicated maths in terms of the distribution to figure out what the top 1% threshold would be. Some estimates would say it could be somewhere in the region of 2.7 million from the World Inequality Database. We came up with a yield of about 1.1 billion based on that, which isn't transformative given public spending is well over 100 billion, but it really, really matters. And just to give you some examples, you could make public transport free for that. You could make childcare free for households. There's all sorts of things. You could give an endowment to all people as they turn 18, based upon that 1.1 as a form of distribution of wealth away from the 1% to the rest of society. Looking at the other big data set, we had to work out essentially what the top 1% threshold was. We estimated somewhere between 2.5 and 3.5 million just to get into the top 1%. So if you're not at that level of wealth, you don't need to worry about a wealth tax. And your yields that you would get would be somewhere a little shy of 1 billion or maybe in the region of 800 million. By the way, the World Inequality Database 1% threshold is 5.3 million. So your average household won't be affected by this whatsoever. And those very hard cases of an elderly person who maybe used to have a high income but doesn't anymore and is living in a big house, you can see it would only be very, very unusual and rare cases where such a person would be affected by a wealth tax. And in any event, you have to imagine that they would be able to, they would have the wealth assets, including the financial assets, to be able to easily pay a wealth tax, which would be quite small in amount, particularly relative to an income tax. So there is a large argument back and forth, which I think it's maybe good to go through in terms of Q&A about the pros and cons. The big pros are, wealth inequality is simply more concentrated and it will grow over time in the absence of progressive capitalization. Wealth generates more wealth. The wealth tends to become more and more concentrated over time. So it's crucial to any notion of the common good, social equity, any of those issues. And even the IMF, which is hardly a bastion of left-wing thought, argues that increasing taxes on capital generally are a good thing, particularly relative to increasing taxes on labor. And the OECD too has examined the merits and came back positively in terms of the context of wealth taxes as well. There's an argument against, of course, many arguments against. I suppose one of the obvious, most common ones is that it's essentially a form of double or triple taxation, but because it's on top of income tax. But all taxes are double or triple taxation. What do we pay VAT out of? So if you buy something in the shops, you're buying it using the income that has already been taxed, and then you're being taxed again, whether it be an excise tax or VAT or whatever it might be. And you can make similar arguments for all types of taxation. So there's no such thing as unless you only have one type of tax, everything is going to be double taxation. There are problems in terms of valuation difficulties. The paper talks about a lot of solutions around how you can deal with that. Exemptions and reliefs create all sorts of loopholes that would allow really rich people to avoid paying the tax. The solution there is not to have any exemptions or reliefs, a really simplified system, but you can avoid hardship cases by having a high threshold. Uh, Another argument is that it's a disincentive to invest. Actually, no, because you're taxing the wealth. It's an incentive to be more efficient in terms of your investment. Because if it's a 1% wealth tax, hypothetically, you are looking to maximize return on your assets. And if you're not able to do that, you're incentivized to sell your assets to someone that is better able to do that. So it has huge benefits in terms of preventing things like dereliction, which have no return. But if you tax people on that, you encourage them, let's say, to sell the asset to somebody who will actually use it better. So in many respects, a wealth tax, unlike an income tax, can be beneficial to the economy from a growth perspective. Um, so there are other queries. There's other questions. Yes, of course, we know there's a benefit in terms of revenue. There's a benefit in terms of inequality. It helps us hunt down tax avoiders as well. There are things that are happening at a global level, which can be helpful here too. So some of the policies that could be useful would be around the notion of a global asset register. If we have a global asset register, it makes it more difficult for really rich people to hide their assets and to move their assets around the world in an untracked way. Making beneficial ownership, making trusts see-through is very important here. Otherwise, rich people can hide their assets in trusts. So all trusts, if they're made see-through, you can identify who are the beneficiaries. That gets added to their wealth um, as well. So makes it harder to avoid the tax. Obviously, to the greater extent that there's sharing of information between revenue authorities, that makes it harder. That makes it easier to track down wealth as well. There are other things we need to think about in terms of what happens if people leave the country. You can have exit taxes, although I would argue that the wealth tax, if you really break it down, would be quite modest in terms of living standards and well-being for rich households. And most of the people that have an inclination to be a tax exile, let's say, have already left the country. The people that are already still here and are rich are those who've already shown a disinclination to leave. So I suspect the additional amount that leave because of a fairly modest wealth tax is likely to be very, very small, if not vanishing. So, there's a lot of other things that I can talk about, but maybe it's better simply to have the slides, and I'm happy to take questions or whatever it might be. I would note as well that a wealth tax is not a tax on corporations, so it's a tax on households. And what that means is it has no impact upon foreign direct investment by, let's say, US multinationals. What's more relevant there are things like corporation tax, even income tax on high earners. And obviously that is a very, very different tax justice debate, which I'm sure we can happily have. But it's worth noting that a net wealth tax will have no impact on that whatsoever. It doesn't affect US multinationals. Most of the owners of those companies are Americans. They are here to reduce their tax burden, as they would call it, or tax obligation, as we might call it. So it shouldn't have an impact upon foreign direct investment or the Irish economy in that sense. So again, I would argue equity, economic and administrative efficiency, simplicity, reducing power imbalances, all very, very important rationales for doing it. It's not a silver bullet. It's a small yield. It doesn't fundamentally change the nature of capitalism or anything like that, or deal massively with structural change. But even so, it would be a positive step. It would give additional resources, which could be used for public spending, extra welfare spending, whatever it might be, cutting more regressive taxes. So it would have benefits in that sense, and would have no negative cost of living impact on households as well. So I guess I'll leave it at that. I suppose the final thing is, well, why have wealth taxes failed? Just as a final point. And the reason wealth taxes have failed is threefold. One is that there's been a powerful lobby against. There is literally no more powerful lobby than the wealthy. They almost by definition have excess power relative to the average citizen. Therefore, they're very successful at lobbying against wealth taxes. The second argument against has been high administrative costs. Again, that's about poor design. So if you introduce a whole load of exemptions and reliefs, it's going to cause problems. It's going to reduce the yield. It's going to create issues around equality and equity and all of those things. So our solution is you don't have any exemptions and reliefs, but you have a high threshold. And then finally, there's the concerns about increased mobility of capital and offshore and all of those things. But again, that's really an issue of tax design. And the empirical evidence from the academic literature is suggestive of the fact that capital flight has essentially been close to zero anyway, related to wealth taxes. So I don't believe it's a significant concern. So with that, I'll stop because I know I'm coming up on half an hour or possibly past it. So hopefully that gives you a sense of what a wealth tax might look like. But again, the devil is very much in the detail. If you're going to do it, you do it right. We think we've identified the best way to do that, and we think that it is certainly a viable option. Again, this isn't going to fill the massive fiscal gaps we're going to have in the years to come, but it strikes me as almost the easiest thing that you can do in terms of negative impacts upon households. And even if you're on the political right, there is a strong argument for doing it, which is that if you institute a wealth tax, it makes it much more easy politically then to institute all sorts of other taxes on society as a whole. We saw, for example, the French case where Macron got rid of the wealth tax and then introduced consumption taxes, which led to significant pushback there. So if it gives you political credibility that allows you to do some of them harder things that we'll need to do in the decades ahead. So thank you, and I'll stop there.
Wow, goodness, thank you so much, Tom. That was just so comprehensive and really, helped us to get into the details of, what's up for discussion when we talk about the whether there's an appetite. There's certainly a need that you've portrayed really, really well there, or outlined it for us really well, and the potential for it. And I'd love to just ask about questions from the group here, if there's anybody that would like to bring out anything from the discussion or other questions that you wanted to address while we have Tom. Feel free to just unmute or put it in the chat, whichever you prefer. Yay, come on in, Mian, if you would like to.
Thank you, Tom. That was great. Just when you were speaking about, I suppose, political concern in relation to, somebody is retired and left in their big house, and people's fear that wealth taxes will be in and around losing that family home. And they absolutely do not have the assets. They're not in that bracket that you've described, which were the wealthy. So this association, which is apparently, well, could be maybe more international, that those types of houses internationally would usually be associated with people, say in Switzerland or these wealthy countries, America, and the way the housing structure and colonialism has hit Ireland. There are many once-off housing situations that are, in inverted commas, large houses, and they're not in the bracket you're discussing. I think that's a very big gun in the arsenal of people who are against wealth taxes, because this is a population fear. I grew up at the daughter of a widow, for example. So, that's a situation. But, now with, a council house, what is it, nearly $1 million or something? It's very different now in Ireland, comparing that sort of idea I feel it's from the international stage. What do you feel?
I would say, I think, thanks so much for that. I think probably when you're looking at just the top 1% of households, we're probably looking at a threshold in practice of at least 3 million. So there wouldn't be many houses that would be remotely close to 3 million. In addition, it's only taxing the bit above that 3 million. So if you've got 4 million in assets, you're only being taxed on 1 million of that. And I would also note that if you look at the wealth held by the top 10%, and even more so the top 1%, the value of their home, their principal primary residence at least, is only a very small component of their wealth.
Yes.
Much more of the wealth is held in business assets, financial assets, and things like that as well. Quite quite liquid, much more liquid than for more average households. So I think in practice, the example of an elderly person who has a house worth three or well, actually, let's say 5 million, and doesn't have cash assets to pay an annual wealth tax would be vanishingly rare. What we do with the local property tax is, or at least has been suggested with a wealth tax too, is that you could put a lien on the assets so that if there is a genuine inability to pay, and one of the ways you would look at this is by having a ceiling relief. So a ceiling relief basically says that the wealth tax that you would pay wouldn't be more than a certain percentage of your income in a particular year. But if you have a very, very low income, the ceiling relief would help you. And in that case, if it goes above that, it would only come due when the person passes away. And therefore, it would give revenue first call on the assets before inheritance rights and so forth would take hold, and that would alleviate any concerns, I hope, in that regard. But I suspect you would be talking about a very, very small number of households that would be in that situation. But putting a
Yeah,
lien in
great.
that way doesn't reduce your revenue because it'll get to the government eventually. It'll just be delayed, and then after a number of years, the delayed income coming in compensates for the amount of money lost in a particular year, and the government would get it all eventually. So
Very
hopefully that
clear. Thank you.
will alleviate concern.
Thanks, Tom. There are two questions there in the chat. One comes from John McGee, who's down who's there in Mill Street, the great school for GCE in Cork, and wondering about the discussion about these about wealth taxes in political circles. I suppose do you think they've been well thought through? I suppose what kind of appetite there is there realistically. And there's another question from Hilary about the potential for wealth tax to be part of the call for reparations in terms of colonial and ongoing neo-colonial injustices. And I can post a link in the slides that we'll share afterwards that has quite a detailed breakdown of that from the Tax Justice Network. But those are the two questions we have, I'd say, for now in the time that we have left.
Very good.
If you
In terms of the first question, unfortunately, the wealth tax often becomes a kind of a punch and Judy type thing, where on some sides, maybe unviable wealth taxes can be described, and on the other side, they're just simply poo-pooed as not realistic, mainly because of who they affect. But I do know the Department of Finance is doing research in 2026 on the potential for a wealth tax. I think part of it is there are political developments in terms of the G20, which has come out in favor of a wealth tax. There's arguments for increased global studies on wealth taxes and wealth distribution, and fears about artificial intelligence and increasing inequality are perhaps driving the debate as well. So one of our goals here is to try and make the debate about a serious tax that you could actually do, rather than just the Punch and Judy type thing that we've seen in the past, almost cartoon wealth taxes. So I think it's becoming more reasonable and more sensible a debate. It's absolutely a viable tax, but because of the way it's been done in the past, maybe it's not perceived as such. In terms of reparations, yeah, I mean, if there was any tax base you were going to use to pay for reparations, it would obviously be a wealth tax, particularly in countries with a darker colonial history than Ireland, but also in Ireland too, as part of that process. Certainly, if you look at the United Kingdom and France and places like that, clearly it is the top 1% of society that were much more likely to have been the people that that were responsible for the exploitations of the colonial period. So if you're bringing in, let's say in the Irish case, maybe not a full percentage of GDP, but a proportion of it, you could certainly link it to the ODA would be a natural one to do that. And we know, of course, even on that level, countries aren't making the 0.7%, never mind going further in terms of reparations. So yeah, if there's to be any Irish tax that would be naturally linked to reparations, it would clearly be a wealth tax.
Thank you, and thanks very much for that. Darry, are you going to share a question as well?
Yeah, thanks a million, Tom. I was just wondering, since the report, what what kind of reaction has it received in the trade union movement? Has it been picked up much? And secondly, in terms of how we might begin to try and campaign on this issue in Ireland to implement a wealth tax, do you have any recommendations for practical steps that civil society organizations can engage in?
Well, the trade union movement has adopted it as its policy. So the trade union movement goes in and meets with government and employers as part of the LEAF process, Labour Employer Economic Forum. It's kind of like a new version of social partnership, but not really social partnership, at least not yet. And certainly, a wealth tax is a consistent demand from the union side. It's also part of their new economic model template, which has been developed within the trade union movement in recent years. I was part of that. So wealth taxes are certainly part of that. I think in terms of campaigning, Oxfam are hoping to get in front of an Oireachtas committee, or at least in front of the AV room later this year to have a debate around wealth taxes. In terms of campaigning, I think it's a natural one. It's one that shouldn't alienate any of our core groups. It's not as complicated an issue as people would like to make it. It's, if you say no exemptions and no release, but high threshold, it's simple. It's going to proportionally hit billionaires and millionaires. I think there's a good opportunity now because it's one of the few taxes that won't hurt households that are reeling from a cost of living crisis. So there's the angle of, well, let's make our tax system consistent with cost of living pressures. So the first place to start is everyone contributes, begin with a wealth tax. And that would seem to be a natural one to me. Also, there is a greater fear of an understanding of the grotesque levels of wealth held by the tech bros. And they're like, and there's a hatred of them, I think, generally, and a fear of them, and an understanding that their power is overweening. You look at the Trump regime's inauguration, and you see all the tech bros, all the billionaires sitting behind, showing that the power that they have, even though his intent was to be the other way around. The fear that such a thing could happen in Europe or spread throughout Europe, I think, is something that people are concerned about. I think there is a greater fear of and concern about wealth inequality. And also with the cost of living crisis and the fact that wages have been fairly stagnant in many countries for a number of years, with some people winning and other people not succeeding, that rancor and resentment, unfortunately, has been channeled in many ways toward the far right. But I think with the right messaging and the right argumentation, we can make it about pointing out who the actual problem is here, which is people with excess wealth, and controlling that. And a wealth tax is one of the levers, only one of the levers. There's others, such as regulation and so forth, that we can use to deaden or at least weaken their malign influence on the rest of society. So that doesn't really help or answer the question, but I think all NGOs, trade unions, we need to work together, have events around wealth taxes, public discussions, make them have consistent messaging on this and other issues, so that there seems like there's a movement coming that at least political parties on the left will embrace it as policy, and therefore, ideally, when it gets to program for government in 2029 and manifestos and all of that, that it's part of the discussion. Clearly, the current government won't do it, but at least now it's something that's been talked about within the civil service. Hopefully that helps.
Thank you so much, Tom, and thanks for bringing in that, like, just hugely important context of the slide towards the far right and how much ground they can gain by exploiting the very real pain that is being experienced in our society and globally, by coming up with a very simplistic analysis of it and therefore a very brutal and simplistic solution. Whereas I think this kind of discussion about just the absolute realism and the necessity of wealth taxes to try to bring balance into how decisions are made, how power is shared and or not shared. And I think it was just so striking, you know, that your discussion around what wealth is, even just a reminder of that the majority of us, you know, we don't hold a whole lot of it. You know, 10% of us have virtually no wealth. And as you're saying, around up to about 80% of us, you know, if it's held at all, it's held within the roof over our heads. So, you know, it is an existential issue. It's not something that's that's an unreasonable ask. So I love the pragmatism that you've shared with us. I love that we're discussing this as, you know, a real life possibility and a necessity. In fact, the tax is a tool for social justice. It's a tool for sustainability. You know, and our demands need to be really clear around that collectively and not leave that space to, you know, far right actors and frankly, increasingly fascist, visions of society that actually end up being friends of billionaires, as you pointed out, rather than any kind of natural predator for them.
Yeah, and I suppose, I mean, it's this notion of the common good as well. I've heard the common good used in recent terms about everything from fuel subsidies to cutting the marginal income tax rate, all of those things. Surely fundamental to the common good would be some acknowledgement or some tax that hits the excess power that the very, very powerful have, that the 1% have over the rest of society. And it's no accident that wealth taxes are lobbied successfully against. That in itself shows the power of the wealthy to always protect themselves. So, you know, I would see a wealth tax as being very much part of the social contract, part of the common good, and using those resources then for something that is politically popular and if you put the resources directly towards that popular thing, it makes it much harder then for the 1% to keep fighting against a wealth tax. So for example, if we made public transport free, or we created that endowment that I described earlier, or we made childcare free, then getting rid of a wealth tax means that you're getting rid of free public transport, or you're getting rid of free childcare, or you're getting rid of something else that we really care about. And that would make it more likely to stick longer term rather than simply being seen as an imposition. And it's valuable to keep the threshold high because we genuinely don't want to have a situation where people are going, oh, my house in South Dublin means I'm so rich that I have to pay a wealth tax. So this is affecting ordinary people. You don't want the media to have the opportunity to create those stories. And that's one of the reasons you have to set the threshold high. So having a tax on all wealth, unfortunately, would be politically very unpopular and just wouldn't happen. So that I think means the focus is on excess wealth rather than just wealth per se.
Totally. Thank you very much. I'm going to just ask people in the last minute or two that we have to just, first of all, just share thanks to you, Tom, for sharing all this. It's just so helpful and important to have these opportunities to get into the longer grass of these issues. Also, we'll be sharing Tom's slides. Thank you very, very much, along with some of the other resources that we have been drawing on in our work on tax justice. And so the work that Oxfam, ActionAid, Christian Aid, Trócaire and others and the Tax Justice Network have done in this area has just been really helpful to NGOs like us and to educators who are trying to sort of think about how we do this work educationally with secondary schools, third level, with community groups and so on. And just to flag some of FJI's resources, we do have a resource on a nice entry-level guide to just tax, thinking about tax as a progressive instrument with kind of quite participatory activities like who wants to be a billionaire philanthropist, or looking at carbon taxes, taxes around mining extractive industries. We have other resources that are available there on the FJI website that touch on tax justice very, very directly. And of course, our wider range of global justice resources. And we have, very excitingly, have a resource on donut economics coming up, and one on climate action and sustainable development for secondary schools. But finally, the evaluation form, if you are in a position to fill this out, this is our form for secondary school teachers, or secondary school educators, or people who are involved in working with secondary schools. So it's there in the chat. But if you're in that category, it would be great to get your feedback so that we can share that with Worldwise, sort of the impact of these kind of workshops. And otherwise, it would just be great to have your feedback in the chat or in any other way. And just thank you. I mean, it's clearly this is part of a longer struggle for economic and financial justice, but I personally feel really kind of buoyed up by the information that you've shared, the idea of a social movement of trade unions and other groups and educators that are feeling, confident and literate, I suppose, in terms of making these demands and framing them. I mean, the current demands are very modest. So I think this could be the succum and see version of wealth taxes. And as you say, how that sets the ground for, even more demands for that just and sustainable world that we want and need. So it's just gone to just massive thank you to everybody, and I hope you have a great day, and can bring this work into your own, this learning into your own work, in the future. So stay in touch, everybody, and we'll send out the slides to all the participants. Thanks again, and thank you so much, Tom.
Thanks, Vicky. Thanks, everybody.
It's long.
Thanks.
Bye.
Thanks a million.